Hello everyone. Today we're going to talk about the recent pronouncements related to the amendments made by the IASB, and IASB stands for International Accounting Standard Boards, which sits in the UK, and this is a prime body which this sets the whole standards or the related pronouncement for international financial reporting standard, as you all know. So recently, on the 12th of December 2017, they have come up with some of the amendments which are in the specific standards, and the applicability of these changes will be from 1st January 2019. However, they allowed for entities, if they want to change as per the amendments early, they can do so, but they have to disclose it properly that they have changed it or they have adopted these amendments early. However, the compulsory or the mandatory requirement to adopt these changes still remains 1st January 2019. So basically, there are four major areas which has been amended by the IASB. So the first one is, if you can see on your slide, related to IFRS-3, which stands for business combinations. It says about, like, for if you can recall it, that for while doing our control assessment for an entity where we don't have the absolute control, so we usually find the cases where we have the two or three parties which are having the the kind of the joint control. So we have the IFRS-11 111, which is for joint arrangements. So, IFRS-11 for IASB, and for IND-as version it is IND-as 111. So in the joint operations, we have the joint operation is nothing but the extension of particular kind of the business activity of an entity, where we are usually don't have the the kind of the entity or the separate kind of the legal structure of that entity, and there are some operators which which come together and they accept it for the how the business operation will be done. So they usually get into some contractual agreement where they have some percentage related to their assets or liability, and accordingly their recognition and measurement for those asset and liability in the proportion, that is how it is being accounted in their books of accounts related to joint operations. So now what the ISB has recently changed is, they says that since the joint operation is kind of the percentage allocation of particular asset or liability of a joint operations activity. So example, like two entities are are joint operators, and they are having some X percentages in their asset liabilities, or X is the percentage on asset wise, and because there could be n number of percentages for n number of asset or liability. This is what the how the joint operations works. So what the ISB says, like for example, the joint operators per se, if either of one of them acquires the control over this joint operation. So controls, again, it will be like reflecting for what we have in the IFRS 10, which is for the consolidated financial statements. For Indian perspective, it is the IAS-110. So now the ISB says specifically for that, if any joint operators which are in the joint operations, of course, if they are getting the control over this joint operations, so it will be like kind of the we will treat it as the business acquisition which is acquired in the stages, which we already have in the IFRS 3. So they specifically put into that particular the para which is to be notified or which is to be given in the recent time. So it will be like now the whatever is the earlier interest in the joint operations, it will be remeasured. So remeasures means it will be fair valued. So for example, the 10% of the rights were having by the joint operator, Now he has got the control. So the 10% which was previously held will be remeasured, will be fair valued at the time of the such accounting. So the acquisition date accounting, of course it's a fair value, so the previously held interest also will be fair valued. So now the fair value accounting will be done and it will be treated as a business acquired in the stages. That is what it is specifically now amended in the IFRS 3. Coming to the second changes, which is related to IFRS 11 joint arrangements, which we just talked about and briefed it about, and this is again related to the joint operations. So now these ISB, what their the deliberations has come up on that particular segment, where they say that if somebody is having the joint operations interest, like again the operators having some percentages in the asset or liability, and they are getting into the joint control. So it's like if somebody is not getting the full control. So in the first one we were referring about the control means it is the absolute control by that particular operator. In the second one, we are talking about the joint control. So joint control will be like, if the operator, which is in the joint operation, if they are getting into that the full control over that particular entity, which is the joint controls, means one or two parties will have to take a decision on their, the both should agree, or the consensus should be there for the all parties which are having a joint control. So here the ISB says that, in those cases where some party was having the joint interest in the joint operation and subsequently they are having the joint control, so there is no need to measure the previous percentages which were having as a joint operator. So the simple reason was like, there's economies is not something which is to be linked for the joint operator to joint control. So I mean, like for ISB, they clarified that in those cases there is no need for making any remeasurement. Coming to the third changes which has brought into related to the income taxes, which is IAS-12, and from Indian perspective it is IND-as 12. So now there are a lot of deliberations which has done by the ISB in their improvement this cycle, and there were a lot of queries which were coming from different the stakeholders, and there was some situations where like if company is distributing some dividends which has actually released, or which is actually a function of kind of the realization of an instrument which is classified, either it's a equity classification was done or liability, or it was valuing at the fair value through OCI kind of instruments. So instrument classification is totally depending on the IFRS 9, so financial instrument related. So now the question came like for putting the income tax related provisions. So where the particular tax effect for the deferred tax effect, where the deferred tax effect should be should be accounted for in relation to these different classification. So ISB has indicated and specifically amended that, and they said that, like for example, if you have any financial instruments which has been classified due to some the criteria were being met, and they classified it either fair value through OCI, or it was classified in equity or liability, kind of basing on their the characteristics, and later on the company is distributing the profit which is related to those instruments realization. So the tax effect of those dividends also will sit in the same bracket. Like for example, if it is related to an instrument which were classified in fair value through OCI, so their related tax also will be sitting in the OCI. So that is what they have changed. The fourth one is related to the borrowing cost, and again it is in the IAS-23, and from Indian perspective it is IND-as 23 borrowing cost. So there were not the specifically mentioned in the standard earlier, but now they have brought into the specifically the amendment in the standard, and they says that for example, you bought some loan for a particular asset which is fulfilling the criteria being a qualifying asset, and once the qualifying asset is completed and he is ready to be used or put to use. So your specific borrowing which was related to that asset, it should be stopped. But there will be many cases where the loan or the borrowings is not yet over and still the the borrowing related expenditure is going on. So now the standard is specifically amended, and it says that once those particular specific borrowing which were related to the qualifying asset, if it is over and the qualifying asset is ready to use, so still the borrowing is left, then those borrowing will be included in the general borrowings. So general borrowings, it is still to be accounted for as it is being accounted for in the current scenario. So these are the four major changes which has the ISB has suggested, and it is all depending on the how the entity seeing that those changes will be affecting their transactions, and they are free to take the early adoption or their have their diagnostic done or the impact analysis for affecting these kind of changes to their systems, or if it is they find it is useful to adopt early, it is very much permissible, and they can do that while disclosing that they have adopted these changes early, or it's a 1st January 2019, it's a mandatory application for all these changes. For more details and more articles on the IND-as or IFRS, you can log on to www.gyanifrs.com, or you can email us to us for whatever your queries or wherever whatever the particular topics you want to explore further in their real time situations or your business feels like, and feel free to send your emails on the contacts or the details available on the websites. Thank you.